Welcome back to Iron Financial, the channel where we help you forge a stronger portfolio, cut through the market weakness, and literally build your wealth on a rock-solid foundation. If you want to keep constructing a winning strategy, hit that subscribe button right now. Okay, let's dive into this. Look, in a market that is just absolutely full of tech bubble hype and endless AI promises, we are always looking for companies laying real bricks and mortar. We want the companies doing the actual heavy lifting in the economy. So today, we're putting CSW Industrials through our ultimate financial stress test. We are breaking down their fiscal year 2026 results. Now, this is a diversified growth company, and they operate across Contractor Solutions, specialized reliability solutions, and engineered building solutions. But here's the thing. The foundation of the recent earnings report has definitely sent some shockwaves through the market, and we need to inspect the structural integrity of this stock. By the end of this explainer, you're going to know exactly if this company belongs in an Iron Financial grade portfolio. Just look at the sheer scale of the top line they just reported. I mean, they've crossed a massive threshold here, pulling in a staggering $1.08 billion in record revenue. That is a colossal milestone for management, and honestly, it's absolute proof that their growth blueprint is executing at a phenomenal scale right now. Hold on a second, Lead. You can paint the penthouse all you want, but as an investor, I really only care about the bottom line. And let's be real, the basement here is flooding. Earnings per share, the actual profit that shareholders care about, plummeted by 20%. Net income dropped from $137.4 million all the way down to $112.8 million. For anyone managing their own money, seeing the bottom line cave in like this is just terrifying. So what does this actually mean for your money? It means you absolutely cannot celebrate a billion-dollar revenue print when the structural profitability is quite literally caving in on itself. This right here is the core debate we need to hammer out today. Is this growth real, or is the foundation cracking?
I totally hear your skepticism, but you really cannot ignore the heavy lifting that CSW's management team has done here. Reaching $1 billion in annual revenue in just a decade, that's a testament to a highly effective, aggressive growth strategy. They're expanding their reach in critical, highly durable end markets. Think residential and commercial heating, ventilation, air conditioning, refrigeration, and plumbing applications. And let's drill down into why these specific markets actually matter to you. Think about it. When a commercial HVAC system blows out in the middle of July, a business doesn't just sit around and wait for interest rates to drop before fixing it, right? No, they call a contractor, and that contractor buys CSW components. That is the durable, recession-resistant demand driving this billion-dollar print. The professional end users out there rely on CSW's niche, value-added products to keep the real economy functioning. This isn't just some flash in the pan. This is a company that has fundamentally upsized its structural footprint in the industrial space.
Let's act as the architect for a minute here and reveal the actual blueprints of their structural growth. We're looking at a 23.3% year-over-year revenue jump. They went from $878.3 million in fiscal 2025 straight up to $1.08 billion in fiscal 2026. What this means for your portfolio is really understanding the headwinds they fought through to get here. That is an addition of over $200 million in top-line revenue in a single year, and they achieved it despite massive macroeconomic headwinds and severe destocking trends in the residential HVAC and plumbing markets. For those of you newer to the space, destocking simply means wholesalers had way too much inventory sitting around in their warehouses, so they just stopped buying new parts until they cleared out the old stuff. But even with that huge bottleneck, CSW is pushing forward with a master plan that is clearly driving the top line continuously upward.
And how exactly did they build this top-line structure? Through a relentless, highly targeted $1 billion acquisition spree over the last 12 months. They deployed capital so aggressively to bolt on high-value assets. The crown jewel here is for sure the $650 million Mars parts deal, which was their largest to date. So why does this matter for your portfolio? Because Mars provides immense scale in the HVAC aftermarket, giving CSW this massive distribution footprint that they just couldn't have built from scratch. They also rolled in Aspen Manufacturing, Hydrotex, and Pro Action Fluids to broaden their specialty lubricant and HVAC parts offerings. And I absolutely love the strategic duct strip buyout they completed in the fourth quarter. It gives them an immediate entry point to accelerate sales of a highly differentiated electrical cable tailored specifically for the fast-growing HVAC mini-split market. This is a deliberate, calculated acquisition blueprint specifically designed to dominate the sector.
Okay, but is this just hype, or is it real? Because let's be honest, anyone with a checkbook can buy revenue. The 10K filing explicitly states that 25.3% of this year-over-year revenue growth was driven entirely by acquisitions. In other words, this isn't genuine organic strength. This is bought revenue padding the foundation. If you look closely at the third quarter data, they actually reported a consolidated organic revenue decline of almost 3%, and it was heavily concentrated in their Contractor Solutions segment. That segment actually saw organic volumes drop by $6.8 million due to market weakness and that exact destocking you just mentioned. For your portfolio, bought revenue without underlying organic growth is a massive red flag. If the legacy products are losing steam, the overall structural integrity is highly compromised, no matter how many shiny new companies they bolt onto the side of the building. I have to disagree that the core is compromised. Contractor Solutions is the primary load-bearing segment of this entire business. It makes up roughly 59% of their total revenue. Yes, there was absolutely some residential HVAC destocking, but this segment still returned to positive organic growth in the fourth quarter. And let's translate what run rate synergy actually means for your money. Management announced they've already exceeded their initial $10 million run rate synergy objective for Mars Parts. They aren't just buying companies for the sake of it, they are ruthlessly integrating them. They're squeezing out $10 million in cost savings right out of the gate by combining operations, cutting redundant software, and streamlining logistics. They even completed the ERP integration right on schedule. They are actively fortifying this core segment, and they fully expect continued product expansion, share gains, and real pricing power in fiscal 2027.
Well, let's talk about the true cost of that growth then. Now, what's really interesting about this slide is that the top-line revenue is a shiny 23.3% higher, right? But GAAP earnings per share plummeted by 20%, down to $6.70, and net income completely collapsed by 17.9%. As an investor, you just cannot call this a flawless blueprint when the top-line growth is masking some severe bottom-line bleeding. They are bringing in way more cash at the register, absolutely, but significantly less of it is actually making it to the shareholders' pockets. This is exactly what happens when you try to scale too fast. The sheer cost of running this larger, newly acquired infrastructure is severely dragging down their overall efficiency. They are getting bigger, but they are absolutely not getting leaner.
And look, we always go straight to the SEC filings at Iron Financial, and the 10Q reveals a pretty harsh reality here: severe margin compression. In the third quarter alone, gross margin declined by 170 basis points, from 41.4% down to 39.7%. Adjusted EBITDA margin dropped 250 basis points. Why? Because they are taking heavy hits from higher input costs and navigating severe tariffs on steel, aluminum, and copper. They explicitly noted in the filings that China represents 10% of their Contractor Solutions cost of goods sold, and Vietnam is in the low 30s. That reliance is a massive geopolitical risk for the stock. If supply chains tighten up again or trade tensions escalate further, this margin compression is going to cause irreversible structural damage to their profitability.
And here is the heaviest weight cracking the foundation right now: the interest expense. In fiscal 2025, their net interest expense was a highly manageable, almost negligible $0.3 million. In fiscal 2026, it skyrocketed to $22.2 million. That is $22 million of pure cash just evaporated. Think about it. That's cash that could have been used for R&D, cash that could have been paid out to you as special dividends, or even reinvested to fix their organic growth problem. Instead, it's walking right out the door and going straight to the banks just to service the massive debt they took on to fund this aggressive M&A strategy. When you build a house entirely on credit, the mortgage payments eventually catch up to you. This kind of staggering interest expense entirely cannibalizes the operating income gains they were hoping to achieve. Which leads us directly to the leverage ratio. They are now sitting on a massive $764 million net debt load, pushing their net debt to EBITDA ratio to 2.3x. What does that mean in plain English for your portfolio? Well, in today's macroeconomic environment, anything over a 2x multiple starts to severely restrict a company's financial flexibility. A year ago, they had a pristine balance sheet, and now they are heavily leveraged. High borrowing costs can absolutely crush future M&A abilities. In an environment where economic uncertainty is still lingering heavily and organic volumes have shown weakness, strapping an anchor of $750 million in debt to your balance sheet is a massive risk. I have to aggressively question if this leverage ratio is a fatal flaw in their master design.
Okay, actually scratch that. You're getting completely bogged down in GAAP accounting traps here. Let's look at the actual cash-generating reality of the business. For everyone watching, we really need to strip out the noise. First, they took a $15.6 million non-cash impairment charge related to Greco. Second, because of this $1 billion acquisition spree, their annualized amortization of intangible assets has naturally risen to approximately $63 million. What you need to understand is that amortization is just an accounting deduction on paper. It is not actual cash leaving the business. When you add back that non-cash amortization and those one-time impairment expenses, adjusted EPS actually grew 6.9% year over year to a record $10.38 per share. Adjusted EBITDA increased 18.3% to a record $269.6 million. The core cash-generating engine of this business is incredibly robust once you actually clear the accounting dust from the construction site.
And management isn't backing down either. CEO Joseph P. Arms went on record stating, and I quote, "Disciplined investments in immediately accretive acquisitions have added fast-growing products to our portfolio, opened new end markets, and allowed CSW to leverage our broad distribution network. They are projecting meaningful growth in revenue, adjusted EBITDA, adjusted EPS, and cash flows for fiscal 2027. And if you want proof that this strategy is actually working, look at their forward signals. They noted that January order rates were very strong. That is a massively bullish signal that the whole destocking nightmare is finally ending and distributors are finally reordering parts. The long-term structural integrity of the residential HVAC, plumbing, and electrical end markets remains rock solid, and CSW is perfectly positioned to capture that upside.
Let's move to this and see how this builds into real returns for your pocket. Because you don't raise dividends if your foundation is crumbling, right? CSW initiated their dividend in 2019, and they have delivered successive dividend growth for 6 straight years. They just announced another increase to $0.30 per share for the upcoming quarter. Over the fiscal year, they generated a massive $132.3 million in free cash flow. That free cash flow is the true lifeblood of the company, and it easily covers their dividend payout while leaving plenty of capital to service that debt you're so panicked about. Delivering a growing yield while simultaneously digesting $1 billion in acquisitions is the absolute hallmark of a structurally sound business.
And if you want the ultimate proof of management's confidence, just look at their share repurchases. They literally dropped $127.5 million to buy back their own stock this year. In the third quarter alone, they spent $70 million on open market repurchases, buying back 283,000 shares at an average price of $246 per share. What this means for your portfolio is that management is effectively setting a floor on the stock. When management drops $70 million on their own stock at $246 a pop, that's an ironclad vote of confidence that they believe the intrinsic value is much, much higher. They are eating their own cooking, returning capital to shareholders, and actively reinforcing the portfolio's equity foundation because they know the market is undervaluing their long-term earning power. Okay, it is time for the verdict. We have laid out the blueprints, we have stress-tested the beams, and we have thoroughly inspected the cracks. The bull case, $1 billion top line, record-adjusted EBITDA, consistent dividend growth, and a management team ruthlessly buying back their own stock. And the bear case, $764 million in debt, a $22 million interest expense anchor dragging them down, shrinking organic growth in their legacy segments, and a 20% decline in unadjusted bottom-line earnings. The duality here is extreme, no doubt about it. The aggressive acquisitions have undoubtedly transformed the sheer size and scale of the company, but the massive cost of that growth has severely tested the limits of their balance sheet. So, we leave it to you, the iron financial community. We've given you the raw numbers, the GAAP versus non-GAAP realities, and the truth about their massive debt loads.
So, what's the call? Is CSW an industrial titan currently on sale, ready to dominate a $1 trillion market? Or is this a debt-laden trap about to snap under the weight of its own interest payments?
Drop your verdict in the comments below. Let us know if this stock belongs in your portfolio. Make sure to like this explainer, subscribe to the channel, keep your discipline, keep your edge, and keep your portfolio ironclad. We will see you in the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.